if I told you to picture a bank with nearly $10 billion in hard assets, a place that handles billions of dollars in loans every single quarter.
You'd probably picture this massive 100-year-old marble building on Wall Street.
Right, exactly. But what if I told you that the bank, recently named the #1 bank in America, actually started as like a smartphone app for refinancing college loans?
Oh, and it gets crazier. They are now actively minting their own cryptocurrency.
Yeah, it's wild.
And they're operating all of this not from some traditional teller window, but from what is effectively a digital command center. I mean, we are looking at a complete architectural rewrite of how value moves across the economy.
Okay, so let's unpack this, because today our mission for this deep dive is to decode the Q1 2026 earnings call from SoFi.
Right.
We're drawing directly from the strategy laid out by their CEO, Anthony Noto. And our goal here is to figure out how this company evolved into this absolute financial juggernaut.
Yeah, they're operating right at this intersection of traditional lending, artificial intelligence, and what they're calling a new crypto super cycle.
A super cycle, yeah. And for you listening, here's exactly why you should care about this deep dive. Even if you don't own a single share of their stock.
Or even if you've never downloaded their app.
Exactly. So SoFi's strategy is essentially a blueprint for the future of your own wallet. This is about how your money's going to move, how it'll grow, and how it will be managed over the next decade.
It really is a window into their playbook for building this everything financial app.
But, before we get into the sci-fi stuff, the blockchain and the AI,
Yeah.
we really need to look at the scoreboard for today. Because if a company says they're reinventing finance, well, their current financials better actually back it up.
And looking at the numbers from this earnings call, I mean, it is a massive validation of their model.
Yeah.
Yeah. They just hit their 18th consecutive quarter of what's known as the Rule of 40.
Okay, wait, let's pause there. Because for those who might not live and breathe growth company metrics, the Rule of 40 is a benchmark. It's used mostly in the software world, actually.
Right.
It basically says a company's revenue growth rate plus its core operating profit margin should equal or exceed 40. It proves you can grow fast without just, lighting money on fire.
Which is really hard to do. Most tech companies struggle to hit 40.
Yeah, but in Q1, SoFi scored a 72.
A 72, which is driven by 41% revenue growth combined with 31% EBITDA margin.
EBITDA margins, which is basically just a fancy way of saying their core operational profitability.
Right, exactly. So they aren't just growing rapidly, they are growing highly profitably. I mean, they generated over $1 billion in cash revenue for the second consecutive quarter.
Wait, though. I mean, scoring a 40 is considered the gold standard for a healthy tech company.
Yeah.
If they're hitting 72, what are they sacrificing to get there? Or, I don't know, have they actually cracked a completely new efficiency model for banking?
It is absolutely a new efficiency model. And it all comes down to customer acquisition cost, or SAY.
Okay.
To understand how they hit a 72, you have to look at their user base. They hit 14.7 million members total.
Wow.
Yeah, adding 1.1 million in just the first quarter alone. But here is the metric that explains that incredible profit margin. 43% of new financial products were opened by existing members.
Oh, wow. Okay. That makes perfect sense. They don't have to spend a dime of marketing money to get that second or third product sale.
Precisely. In legacy banking, acquiring a customer for a checking account is incredibly expensive.
Right.
And acquiring a customer for a personal loan is also incredibly expensive. You pay heavily for both. But SoFi's mechanism is totally different.
Because they might spend money to get you in the door for like a basic zero-margin checking account, right?
Right. But because the interface is entirely frictionless, when you inevitably need a high-margin personal loan 2 years later, you just click a button in the same app.
So the marketing cost for that second product is effectively zero. It reminds me of the Costco membership model for your money. Think about Costco. Once you trust the ecosystem to give you a good deal on bulk groceries, the friction of shopping around is completely gone.
Yeah, you naturally start buying your tires there.
Right. Booking your vacations through them, maybe getting your eyeglasses there. You already trust the building. And SoFi is doing that with financial products.
And it's working. Just this month, Forbes named them the #1 U.S. bank, specifically highlighting that they scored exceptionally high on trust.
Which is a remarkable shift, honestly. They are beating out legacy institutions that have spent, a century building brand authority?
Easily a century. And their stated mission plays right into building that trust. They say they want to help you spend less than you make and invest the rest.
Why? So you can actually choose where to live, what size family to have, when to retire. They are selling the mechanics of financial independence.
Not just a place to park your paycheck.
Exactly. But um, trust and cross-selling are just concepts until they generate actual yield. We have to ask how this ecosystem translates into hard revenue today.
And the answer to that lies in their lending engine.
Right. Because behind the slick, high-tech interface, they are fundamentally a bank making loans.
Yes, and their lending segment just had its best quarter ever. They generated $629 million in adjusted net revenue on $12.2 billion in loan originations.
$12.2 billion.
Yeah. To break that down mechanically, they originated $8.3 billion in personal loans, $1.2 billion in home loans, and $2.6 billion in student loans.
Wow.
In fact, they helped 10,000 members finance their education this quarter and helped another 10,000 completely pay off their student debt.
That's huge. But the mechanics of how they handle this $12.2 billion in debt is where the strategy gets really interesting to me. The CEO broke their lending engine down into two distinct channels.
Right, the balance sheet and the LPB.
Yeah, the balance sheet, which took $9.2 billion, and the loan platform business, or LPB, which handled $3 billion. Let's see if I had the mechanism right here.
Go for it.
With the LPB, SoFi uses its app to originate the loan, but then they immediately sell that debt off to third-party partners. So SoFi gets a big chunk of cash up front in fees. It frees up their capital instantly to make another loan, and it completely wipes away their credit risk.
Because someone else is left holding the bag if the borrower defaults.
Right. Is that accurate?
That is exactly how the loan platform business functions. It's highly capital efficient and removes default risk entirely.
Okay, well then I have to push back on their strategy a bit. If the LPB instantly frees up capital and completely removes credit risk, why doesn't SoFi just put all their loans through the platform?
It's a fair question.
I mean, why are they intentionally holding $9.2 billion of debt on their own books and taking on that massive default risk?
It's a strategic balance of cash flow duration. See, the platform business is fantastic for immediate liquidity, but it's purely transactional. You only get paid once. Holding loans on their own balance sheet, while absolutely carrying default risk, is the engine of long-term wealth creation for a bank. When they hold the loan, they collect net interest income.
Ah, right.
In Q1 alone, that net interest income brought in $690 million. It provides a highly visible, highly predictable stream of recurring cash over the life of, say, a 5 or 10-year loan.
So they are using the transactional cash from the LPB to fund their operations today, while the balance sheet loans build a durable bedrock for tomorrow.
Exactly. And to mitigate that default risk on their balance sheet, they're aggressively deploying AI.
Oh, the Doc Coach feature.
Yes, they just rolled out Doc Coach. It uses artificial intelligence to automatically validate pay stubs and financial documents for personal loan applications.
Think about the traditional nightmare of applying for a loan, right? Trying to hunt down a physical scanner in the year 2026 to fax your W-2s to some loan officer who takes 3 days to read them.
It's awful.
But SoFi's AI just reads the digital document, validates the income, and evaluates the risk instantly.
It dramatically reduces the operational friction for the user while simultaneously lowering the processing costs for the bank.
But, here is the major bottleneck. SoFi has 14.7 million members, rapidly moving money, taking out loans, earning interest. But the traditional banking rails they are forced to run on, they essentially shut down at 5 p.m. on a Friday.
Yeah, the legacy plumbing.
Right. If you need to move large amounts of money over a holiday weekend, your money is literally stuck in traffic.
Yeah.
So to truly monetize these users efficiently, SoFi realized they had to bypass that legacy plumbing altogether.
Which is the primary catalyst driving their massive pivot toward blockchain and digital assets. I mean, the earnings call made it explicitly clear SoFi believes a crypto supercycle is currently underway.
A crypto supercycle. And they aren't just adding a button to let retail users speculate on Bitcoin. They actually launched SoFi USD in December.
Right?
Making them the first national bank to launch its own stablecoin on a public permissionless blockchain. They officially began minting it this quarter.
And a stablecoin, mechanically speaking, is just cryptocurrency pegged directly to a stable asset like the US dollar. So it's designed for pure utility, not wild price speculation.
Exactly. It's a mechanism for frictionless value transfer. And to make that utility practical in the real world, they formed a critical partnership with MasterCard.
Yeah, this is huge. This allows SoFi USD to be settled across MasterCard's global network natively.
Because in the legacy system, Credit card settlements often operate on what's called a T+2 basis.
Right, meaning the transaction happens, but the actual money takes 2 days to clear between the banks.
But by using a stablecoin on MasterCard's network, they are enabling real-time 200-before-7 settlement. They are entirely bypassing the traditional business hour limitations.
And they're expanding this exact same frictionless infrastructure to massive corporate clients with a launch they call Big Business Banking.
Big business banking.
Yeah, they're allowing regulated corporations to hold funds, move traditional fiat cash and crypto via APIs, and natively mint and burn SoFi USD.
Okay, the mint and burn capability is arguably the most revolutionary piece here for corporate treasury management. Let me try a mechanical analogy to explain why that mint and burn feature is so vital.
Go for it.
Operating a corporate treasury in the traditional banking system is like going to a casino, but having to drive across town to a specific ATM, requesting a cashier's check, driving back, waiting 3 business days for the casino's bank to clear the check, and then finally getting your chips to play.
Which is an incredibly inefficient deployment of capital.
Exactly. But SoFi's native API interoperability, this mint and burn feature, is like walking right up to the casino table and instantly trading your cash for chips without ever taking your hand out of your pocket.
Right.
The conversion between regular US dollars and the digital stablecoin happens instantly on the back end.
That perfectly illustrates the mechanism. And what makes this actually viable for Fortune 500 companies is the regulatory wrapper.
Because SoFi is a fully chartered national bank.
Yes. They provide institutional-grade compliance. They're taking blockchain, which many corporate treasurers still view as, radioactive Wild West technology, and turning it into a safe bank-grade utility.
Now, if you spend years building this incredibly advanced instant settlement blockchain infrastructure, what do you do with it?
You don't just keep it to yourself.
Right. So SoFi realized they shouldn't just keep it locked up for their own retail app. They can package the underlying technology and rent it out.
It's the exact same strategic mechanism Amazon used with AWS. Amazon needed massive global server power just to run their own e-commerce store.
Right.
But once they built this masterpiece of infrastructure, they realized they could rent out the excess capacity to other companies. So SoFi is doing the exact same thing with financial infrastructure.
They are rebranding this arm of the business as SoFi Technology Solutions. And rather than just listing off their services, let's look at how a single digital dollar actually moves through this new infrastructure they are selling. It relies on 4 distinct platforms. First, you have the banking core. This is the central ledger that actually holds the record of the money. SoFi is launching this updated core this summer for their own bank, and it's built to support stablecoin ledgering on day 1.
Second, once the money is on the ledger, it needs to move. That's the payment hub.
Right.
They're building the digital pipes, the APIs that plug directly into the government's new instant payment systems like FedNow and real-time payments, or RTP. So if a client bank uses SoFi's payment hub, their customers can send money that settles in seconds rather than days.
Third, as that money moves at light speed, it has to be protected. That's their risk and fraud platform. They offer 7 different products here, and the underlying AI models evaluate over 600 distinct data points for a single transaction decision in milliseconds.
600 data points, that's wild. And finally, the processing platform, which actually issues the cards and handles the authorization.
And they're growing that, right?
Yeah, they added 13 new clients to this processing segment in Q1, including expanding a major relationship with a top 3 U.S. telecom brand.
But I want to make sure we look at the complete financial reality here, because this tech segment actually saw a slight contraction.
It did.
The CEO noted that their tech platform revenue was negatively impacted this quarter by the loss of a large previously discussed customer. Net revenue for the tech segment came in at $75 million. So there is active client churn.
Yeah.
But beyond the churn, doesn't this strategy carry a massive inherent risk? By selling this flawless instant settlement infrastructure to other fintechs and legacy banks, isn't SoFi essentially arming its own direct retail competitors?
It is a calculated strategic hedge. Yes, they are empowering their competitors. But software infrastructure revenue, once it scales, operates at incredibly high profit margins.
But
By becoming the indispensable infrastructure, the core ledger, the payment pipes, the fraud detection engine, they create a massive diversified revenue stream.
So even if they lose on the retail side.
Exactly. If a legacy bank beats SoFi for a retail customer, But that legacy bank is running its app on SoFi Technologies solutions. SoFi still takes a fraction of a cent on every transaction that customer makes. They win the retail game or they win the infrastructure game.
That makes a lot of sense. They win either way.
Yeah.
But shifting gears back to their consumer strategy, building a world-class blockchain-integrated tech stack is completely useless if the average person walking down the street doesn't know you exist.
Right.
How does SoFi actually convince a normal person to go through the headache of switching from their current bank?
It requires an aggressive, multi-pronged brand building strategy. And the metrics show it's working. Their unaided brand awareness, which means a consumer can name SoFi as a bank without being prompted by a list, hit an all-time high of 10%.
Wow, 10%.
Yeah, up a full 3 percentage points from last year.
And you can see exactly where they're deploying their capital to get that awareness. They are going all in on sports marketing.
Oh, big time.
They sponsored the TGL Golf League, adding pro golfers Justin Thomas and Charlie Hull to their brand roster. They sponsored the NBA Play-In Tournament, which saw viewership jump nearly 20% this year.
And they're also playing a long-term demographic game.
Oh, the college tour.
Yes, they launched the Future Wealth Summit, which is a national college campus tour. They are actively getting in front of students to teach them about credit and investing before those students develop ingrained loyalties to the legacy banks.
But brand awareness only gets a user to download the app. The ultimate acquisition and retention tool, the mechanism that physically locks the entire ecosystem together, is the relaunch of their premium membership, SoFi Plus.
Right.
They rolled this out on April 1st. It costs $10 a month. But for that $10, members unlock over $1,000 in estimated annual value.
The perks are intense.
Yeah, you get a 4.5% APY on your deposits up to $20,000. You get a 1% match when you deposit money into your taxable investment accounts or buy crypto. You get unlimited one-on-one sessions with actual human financial planners and massive boosts on your credit card rewards.
This specific mechanism alters the fundamental psychological relationship a user has with their financial institution.
Think about your own bank right now. Would you ever log into your banking app and intentionally volunteer to pay them $10 a month just for the privilege of being a customer?
Absolutely not.
No. Most of us spend half our time fighting with customer service, trying to reverse an arbitrary $15 account maintenance fee.
Yeah.
But SoFi is totally flipping that dynamic. They're turning banking into a subscription service where you actually want to pay the fee.
Because you actively try to earn back that subscription cost. It shifts the consumer from being a passive depositor whose money just sits in an account losing value to inflation to an active participant in the ecosystem. You are suddenly incentivized to move your direct deposit, to use their specific credit card, to invest through their brokerage. Every single action helps you maximize the return on that initial $10 subscription. It is a brilliantly designed behavioral loop.
And what's crucial is that they aren't destroying their balance sheet to offer these massive subscription perks. The earnings call highlighted that their tangible book value ended Q1 at $9.2 billion.
$9.2 billion.
That's up 83% year over year, coming in at $7.21 per share. Tangible book value is essentially the hard physical cash and liquid assets of the company.
Just the real money.
Yeah, and it proves that the capital they raised over the last year was entirely non-dilutive. They didn't water down the value of their shares. They used that capital to build the solid financial foundation that makes aggressive programs like SoFi Plus possible.
It is a masterclass in deploying capital to drive behavioral change.
Okay, let's take a breath and do a quick recap of the architecture we've explored today. We started by looking at their incredible efficiency, hitting that rule of 40 with an unprecedented score of 72, driven entirely by acquiring users once and cross-selling them highly profitable products with zero friction.
Then we explored the mechanics of their lending engine, balancing the long-term net interest income of their balance sheet against the instant, risk-free cash of the loan platform.
We decoded their strategy for the crypto supercycle, leveraging SoFi USD stablecoins, MasterCard integrations, and API mint and burn mechanics to enable frictionless 247 corporate money movement.
Right, and how they are taking that exact AWS-style infrastructure and selling it to their own competitors through SoFi Technology solutions.
And finally, how they tie all this incredibly complex plumbing together for the everyday consumer using sports marketing and the behavioral loop of the SoFi Plus subscription model.
Which leaves us with a really compelling final thought to consider for you listening. We've discussed how SoFi is building a completely modern banking core, integrating stablecoins at the foundational level and embedding their payment pipes into top telecoms and other banks.
Yeah.
It begs the question, is the ultimate endgame for SoFi to simply become an invisible operating system? Think about it. 10 years from now, you might not even have the SoFi app on your phone, but every time you swipe a debit card or close on a house or instantly send money to a friend, SoFi might be the silent engine processing that transaction in the background, taking a fraction of a cent on every single movement of value across the global economy.
That is wild to think about, that massive marble building we talked about at the start of the deep dive.
Yeah.
It hasn't just been digitized, it might be turning into the invisible air that the entire financial system breathes. Well, thank you for joining us on this deep dive into the architecture of modern money. Keep questioning the world around you, and we'll catch you on the next one.